Thank you to the sponsors. Really appreciate everybody being here. And thank you for that nice introduction, Contingent. And also thank you to my friend Tom Brigandy, who invited me to speak to all of you today. This is new for me. I'm not much for public speaking. And I was a little bit apprehensive about doing this when he asked me. But then I thought about it a little bit. And when I start telling my wife, Rachel, about my investment ideas, she cuts me off after 30 seconds. And then I was like, wow, I have people stuck in a room and they have to listen to me talk about whatever trades I did for 45 whole minutes. That's pretty cool. And you know what's even cooler? I'm not going to tell any of you about any of the losers, just the winners. So hopefully this will be interesting. So the title is Entering the Arcane, and I think the sorts of investments that I like to isolate and focus on are a little bit off the beaten path. I have a background in distressed debt and do some event-driven investing, so I'm going to use a lot of acronyms, and I'm going to try and explain what the acronyms are and really talk about what I think are a little bit more bespoke and non-standard investments. But I'll talk a little bit about my current role and who I am. So I'm the Chief Investment Officer of the Diamond Family Office. They've been a great home for me, really great people to work with and wonderful bosses. They've given me a platform to invest in a broad array of assets, both through the internal entity that I manage called Diamond Family Investments, where I engage in more direct, opportunistic, distressed investing, as well as more broadly overseeing all their asset allocation, which is complex and something we'll talk about a little bit at the end of this presentation. I'd also be remiss if I didn't talk a little bit about my mentor, the late Andrew Fredman. Before I worked for the Diamond Family Office, I was the co-CIO of Inglesea Capital, which was a single-family office of the late Andrew Fredman. Andrew was the greatest investor that none of you ever heard of. While you might have heard of his $13 billion hedge fund, Fir Tree Partners, Andrew kept an incredibly low profile. But he was a wonderful mentor to all of those who worked for him. And part of my role as his co-CIO was to oversee a lot of our outside investments, many of which were with his former colleagues and friends that he had worked with. And I got to come to see all of the different guys that he had worked with who attributed all of their success to him. He was the most giving mentor that one could have really had in the business, and just a wonderful, uniquely compassionate guy as well. And something that was also interesting about Andrew is he was a huge liberal, which I'm not. He was a liberal in how most of us would think of the term, politically, but also he was a liberal in the true definition of the word, which is, here's the Merriam-Webster definition of liberal: someone who's willing to respect or accept behavior or opinions different from one's own, open to new ideas. And that was a philosophy that he had for both life, social issues, and investing. And when it came to investment, I would walk in one morning and I'd say, hey, the sky is blue. And he'd say, the sky is red. And he would fight with me for 15 minutes about it. I would say, let's buy government-sponsored entities, Fannie Mae preferreds. It's interesting. I'd show him all my research, and he would push back and push back. And sometimes he would say, you know what, you're right, and we deploy the capital. And sometimes he would say, you're wrong, and you're a moron. And that's how he approached things. He had the ability to be dispassionate, and that's what made him a great investor and also a uniquely great person. We all had all those who worked at Fir Tree, which I didn't, really loved him, and I got to know all those guys. And after his untimely passing, just before the onset of COVID, and we wanted to do something, and I helped coordinate the donation of this ambulance to the people of Israel in his honor. When I worked in his office, one of my more lackey jobs was to open all the mail, and one of the envelopes was a receipt for a donation he had made to donate an ambulance to the people of Israel. So I thought that was a very fitting way to commemorate him and the impact that he had on all of us. With that, I'm going to talk a little bit about the different characteristics of a good contrarian investment. And a lot of these were ideas that I learned from Andrew. He would sit on the beach, essentially. He would wait and wait. And then when there was a dislocation or there was forced selling was his most favorite thing. You want to find something where the guy's a puker. He has to sell. The dealer comes in and he has no choice but to sell to you. And that's when you want to buy and you want to throw in your low bid. So those are what we look for. There's a lot of acronyms here. CDO, CLO is something you guys might have heard of. A collateralized loan obligation or collateralized debt obligation. Those are complicated instruments, but oftentimes they have an obligation to transact and reduce their bonds, and they use what's called a BWIC, which is a bid wanted in competition. So what's a BWIC? It's a long list, like a shopping list, so to speak, saying, I'll sell this many of this at this price, and you can go in and bid for those bonds. And that's oftentimes a unique opportunity. Sometimes the best opportunities are the ones that are just so big that the natural investor base is overwhelmed by the supply. And you'll see that. So I kind of like a barbell approach where you look at small situations where nobody cares because they're too small, or big situations where they're just too big for the natural investor base. So like an arbitrage, the merger deal, we have a merger arbitrage manager in the audience who's a friend of mine, Activision, Twitter, and Time Warner. And those were some of the most largest merger arb deals, and I think because of them, they traded at more appealing spreads because of their large size. And then here's a few different bankruptcies, some of the largest bankruptcies ever. Lehman Brothers, Puerto Rico, crypto claims, and Pacific Gas and Electric. And I'm going to touch on all of these. Most of these were bankruptcies that I invested in, and I thought were pretty interesting. So just why are these investments so uniquely suited to a single-family office? Sure, a private equity or a hedge fund might have the right investor base, duration of capital, but at a family office, we certainly do. We can invest forever, we invest generationally, we can tolerate mark-to-market volatility, and we can hold non-CUSIP or liquid investments. Most of you might know what a CUSIP is, but a CUSIP is kind of like a identifier of a particular security. So something might not have a CUSIP, it might go away in some of the sort of transactions that we look at, and that's interesting to me. So now I'm going to go through about 6 or so of the investments that I've engaged in over the course of my career that I thought were particularly appealing and unique, and hopefully you'll find them interesting. So I'm going to start with the PG&E stock. This was, in my opinion, the most interesting and appealing scalable transaction of my career. This is an investment that I made when I worked for Andrew Fredman. Unfortunately, it ended, or the success happened after his untimely passing. You all have probably heard of Pacific Gas and Electric, the large California utility. And Pacific Gas and Electric was the victim of a law that the state of California had called inverse condemnation, which basically said, who is liable for the fire? If there's any tangential touching of the fire to the power lines, they got to pay for the whole thing. And it's like almost like a Talmudic concept, like if the fire jumps from one field to another, who is liable for that fire? And the answer is I don't know, but in California we all know it's PG&E who's liable, and that's why they went bankrupt. But it was actually the second time they'd gone bankrupt in maybe a 15-year period. But it also created a very unique opportunity. So when I worked for Andrew, we owned the bonds in PG&E, we owned a little bit of equity, and we were gearing up to participate in this backstop. So I'll also talk a little bit about what a backstop is. As a backstop provider, you're kind of a funder of last resort. You're kind of like the anchor in a transaction. You'll agree to provide the capital for this opportunity, come hell or high water at a certain price. And that sounds risky. But this was the biggest one ever. They needed people to participate. Typically, in a backstop in bankruptcies, they're usually very sought after because the backstop comes with a fee, and you can't get a piece of it. But with PG&E, it was just so massive, they needed guys to sign up. So it was a $12 billion total piece, and we committed 32.5 between myself and more so with Andrew Fredman through his partner, his entity, Zoe Partners. And the backstop was basically, we were going to get a fee originally of just under 5.8%, let's call it, plus, and that was going to come in the form of stock and a multiple of 10 times. And my analysis at the time said that PG&E should be trading around 13 to 14 times. The peer group was trading at 17 to 18 times. But there were a lot of bells and whistles here that made it more appealing to me. The most important of which was, in my opinion, it was a heads you in, tails you walk away situation. It was a heavily negotiated document. There were 30 amendments, and in that, there were a number of conditions precedent, including a requirement for a certain rate case to be given to the company, which is that's the governing fee structure for a utility. There needed to be a resolution of how the victims were going to be paid. And most of this money was actually going to the victims, those poor people whose houses were burnt down, or to their insurance companies. So it was, to me, like there were ways out, and the biggest parties, which were Baupost and Appaloosa and Golden Tree and a bunch of hedge funds you've probably heard of, there's no way they were going to commit to funding this unless it was a scenario which was good, in which case we wouldn't have had to fund it anyways. And another point is the fee was paid in stock. So if you were committing to it at a 10 times multiple and you knew the fee was going to come at 13, that 5.8 looks more like 8%. So that's really appealing. So here's the math behind it in terms of what we did at Zoe Partners, which was our Inglesea investment entity. We committed $30 million, and the final iteration, we had to fund a small portion. We had to fund $1.3 million, which was immediately hedgeable. This company also concurrently issued about $4 billion of stock, of the total $12 billion. And then we were able to sell that immediately or hedge it out, and then we received shares that at the time were worth $5.4 million. In theory, if we would have held them till today, they would be worth, I don't know, like 1.8 times that. So it was an excellent, off the charts IRR, and we really never had to put up much money. And this is one of the final amendments. You can see the various commitment parties at the top. You see BG, that was Baupost, Golden Tree, and then down you see Zoe Partners and then little old Irv Schlussel. So it was kind of unique for me that I was able to participate. But did I have $2.5 million lying around in the bank account? Not really. But what I did have was an agreement with my boss and friend, Andrew Fredman. It took a little convincing, but he agreed to backstop my portion of the backstop. But what was even crazier was nobody ever verified that I had the funds, ever. Or Andrew, for that matter. Forget like liquid funds, not liquid, they never checked anything. So another one of maybe the biggest mistake in my career was not adding 2 zeros and I would be in belly or something like that. I wouldn't be here with you today. But either way, it was a successful transaction and something I'm very proud of. So here I am. We're going to fast forward a little bit. This is 4 years ago. In September of 2021, I'm at the SALT conference. I think Anthony Scaramucci spoke to this group. Everybody knows about the SALT conference, and I heard a lot about the SALT Las Vegas, and I was always remiss that I never made it. It was an epic conference, and I heard great things. So this was the first big conference after COVID, and I was like, wow, that's awesome. I'm excited. Excellent speakers like Stevie Cohen, Dan Loeb, the who's who of the industry. It was amazing, and I was really excited to go. And there was a lot of free stuff, a lot of swag. It was kind of like Zorhan's New York, free stuff for everybody. But as we all know, when there's a lot of free stuff, somebody has to pay for it. That's just how it works. So I'm wondering who's paying for this wonderful conference. And I'm standing around in the lobby eating some wonderful, scrumptious food. And there's this kid in cargo shorts and a t-shirt with scriffled hair. And he's hanging out. Everyone's coming up to him. And I'm like, man, I should have taken a picture with him because who was this guy? He was the guy who was paying for the free stuff. It was our friend, the notorious Sam Bankman-Fried. And here's my free stuff. This is my speaker that I use at my kids' birthday parties. And this is an amazing water bottle. Inside this water bottle, no joke, there was a cardboard piece of paper. And in that cardboard piece of paper, there was an NFT, or a QR code to get your own NFT provided to you by FTX. And I should have cashed it out. It was probably worth like 20, 30 bucks at the time, but I haven't heard of the term NFT in quite some time, so thing of the past. But I got to watch Sam Bankman-Fried's ascent firsthand, and I went in to listen to him at that conference, and I was super impressed. He's a brilliant guy, and he spoke so well, and I went on and listened to a number of podcasts, and I was always very impressed with him. And something I'll say, I've had a chance to read all the books. There's a book by Michael Lewis. There's a book, Number Go Up, where they interviewed him, and there's a dispute. Some people think he was this horrible villain. I think he was just a young guy, and things got out of hand. He certainly made some mistakes, and I'll go through all the numbers on FTX, and he commingled customer funds, and that was very bad for the investors in FTX. And wrong, but I think, if I were the president, I wouldn't have just pardoned CZ, I would pardon SBF as well, but he was probably a little bit more democratic, and I don't think he has the money to donate, so it might not happen. Okay, and then so then the following year, 1 year later, next September of 2022, they might as well have renamed the conference the FTX conference. There was a giant racetrack in the Javits Center, and you could ride around and compete with your fellow conference goers on these go-karts. It was awesome. And he was a keynote speaker, but he didn't make it because he was probably busy with other things. He did a video conference. And then the next year, they renamed the conference because he wasn't around to pay for it anymore, and it was unfortunate. So with that, I'll talk a little bit more about my investment in the FTX bankruptcy. So this is the pile of shit hypothesis. What is the pile of shit hypothesis? So when you have a vast entity like Lehman Brothers or like FTX, there's a lot of things in it. It's very big. They make a lot of different investments, and you can't. There's so much stuff. There's going to be a diamond in the rough, and that's where you have the diamond and the golds in the pile of shit. And thank you, Elon Musk, for that. When I asked ChatGPT to make this image, it said it was profane. And it wouldn't make it for me, but Elon Musk came to the rescue. So, FTX had massive venture capital assets. They own Anthropic, which we all know of today, one of the top 5 AI companies. And where the state sold Anthropic, it might be up to 3x from that point. But you were able to do the back of the envelope math, and basically it was very clear to me you were getting a 50-cent dollar when they went bankrupt. And that was excluding their shares in Robinhood, excluding all the missing crypto at the beginning that was eventually found, excluding the clawback against all the guys that they gave free money to. There was just so many sources of recovery, and the claims were initially trading in the high teens. So at the Diamond family office, we tried to buy as much as we could. We weren't able to source as much as I would have liked, but it was a very successful investment. It's very akin to Lehman Brothers. Lehman Brothers was the emblematic of the failure and the excess of the mortgage crisis, and FTX was kind of the crypto boom, or the end of that rung of the crypto boom. And in Lehman Brothers as well, they had a lot of real estate, private equity, and it kind of marked the nadir. So if you're buying the bottom, you're getting all that embedded optionality for free. So I thought that was interesting. And this is the chart of the FTX claims. We bought some in the 20s, we bought some in higher, and we've received a distribution at this point of like 78 cents, and they're trading at 150 on a gross basis. And it was also a very creative bankruptcy plan. And what was creative about the bankruptcy plan is there's a give up. So in typical bankruptcy, my claim is parred out, so to speak. I get par plus accrued, and then I'm done. It goes to the next junior rung of the capital structure, to the more junior creditors. However, in FTX, the account holders really still got screwed. And if I brought one Bitcoin, and I'll show you the math in a minute, I never got anything close to the value of that Bitcoin today. And because of that, I think it's multiple $1 billion of claims that the CFTC, that's Commodities Futures Trading Corporation, and the IRS gave up. They ceded that to the account holders. And here's the math, though. If I'm an account holder and I had one Bitcoin on the day that they filed and I sold it at the prevailing price at 20 cents, I got 20% cents of what it's worth. If I held that to today, where that Bitcoin is worth, before today it was worth 105, a little bit less today, I only got 25 cents on the dollar. So, there's a lot of talk like, if everyone just allowed FTX to recover, it would have recovered on its own and everyone would have got their money out. They did sell a lot of assets at lower prices than where they would be today, but I think they still would have been impaired. Now, there is a kleptocracy in bankruptcy, and there's a massive amount of professionals and advisors, and I think the professional fees in FTX are in the mid 1 billion range, probably eclipsing Lehman Brothers, so that's another thing that kind of screwed the account holders, but they probably would have been in trouble anyways. Celsius was another crypto bankruptcy that we invested in at the Diamond family. It's a guy named Mashinsky, I think. And these claims we bought in the 30s, and they've been parred out already, and there's some small stubs that are related to it. So now I'm going to talk about the different Ukrainian war-related opportunities. Beginning of 22, Russia invaded Ukraine, and it was one of those forced selling puke situations. All the real money, all the mutual funds just started selling their securities en masse, and that created an opportunity. So I'm going to walk through a few different sub-segments of that trade. And something I learned from Andrew Fredman was the idea that you like thematic investing, even crypto. Voyager, Celsius, FTX, and in Ukraine you had corporate, sovereign, Belarus, etc. So it's actually not Kentucky Fried Chicken, but it's MHP chicken, and the brokers call these the chickens bonds. MHP is the largest producer of poultry in the country of Ukraine, and they export all over Europe. As you guys know, Ukraine is the breadbasket of Europe and has a lot of different production capacities, particular farmland. And they also make the grain feedstock that goes into to feed their chickens, and they sell the grain. So, my grandfather, Isaac Engel, was a Holocaust survivor. His business was the kosher chickens in Detroit, Michigan. So when I heard there were chicken bonds, I had to buy them. I bought these bonds in the 30s and sold kind of 70s, 80s, and they all were eventually parred out. What was unique also about this company is they had excellent disclosure. You were able to call the IR and get a call back every week, talk to the CFO in English. They did take a one coupon holiday when the war started, but the analysis was pretty easy. You could see where their operations were, their farms and their plants. They were outside of the Donbass region where the war was really being fought, and they were up and running within a month or two of the start of the war. So the next opportunity was in Belarus. So I would contrast this a little bit to where MHP, there was work to be done. There was analysis that said you were a par recovery. In Belarus, it was kind of what my boss would call a WTF trade. It's a lotto ticket. You're buying something for cents on the dollar, and you're hoping that it's going to recover, but you know that you have duration and you have some optionality. Now, Belarus, as you can see this map right here, is adjacent to Russia. They helped stage the war into Ukraine, very close with Putin. They were actually sanctioned even before Russia, before the war started. You can only buy secondary issuance. You weren't able to buy primary new bonds from Belarus. And I was able to buy like 8 million bonds at 6 cents on the dollar or so. And I thought that was just an interesting option. It was, forced selling. Those bonds had been in the 70s prior to the start of the war. And then, we did more work, and, you got something, it starts going up, you focus on it. And, here's a correspondence that I had with Maxim Yemelyanyahu, who was in the Ministry of Finance of Belarus. And there's a point where I would wake up early in the morning and call him to try and get some information, because there was a process. And I spent a lot of time trying to open a bank account in Belarus. I was thinking, am I actually going to get to go to Belarus to open this bank account? Because there was potentially going to be a mechanism where you could get paid in Belarus from the Belarusian government. They're going to buy your bonds from you at a discount. That never happened, but they were willing to sell them to friendly countries. So there was an ultimate buyer, and who was that ultimate buyer? It was this guy. It was the Kazakhstan, Uzbekistan, and Tajikistan, which are also adjacent to Belarus. They were able to buy bonds, and even to this day, they are the bid that exists through various broker intermediaries. Here's the chart of Belarus. Here's where we bought them. I sold a lot of them in the 60s. I still have a couple million face that are trading at 80 right now, so I'm waiting on those for taxes. All right, so then, the final leg of the war trade, it's this, it's Ukrainian sovereign credit, and in particular, the GDP warrants. So who is this woman, Natalie Jurasko, and what was her folly? Natalie was a very well-educated individual born to Ukrainian parents from Illinois, and she went on to become a successful investment banker, and eventually she was appointed in 2015 as the Minister of Finance of the Ukraine. At the time, Ukraine was severely indebted, and they needed to restructure their bonds. This is well prior to the war. And the solution they came up with was these GDP warrants. And to me, this was Natalie's folly. These warrants were very horribly drafted to the benefit of their their legacy hedge fund holders who inherited these bonds as part of the exchange. They had these provisions, and they did not mature until 2041. So you had many years, and in any given year, you would clip the difference above a base of 150 million in between 3 to 4% real growth, and then 4 to 7% real growth at these ratios. And I'm not going to go too much into the detail of the math, but in a 7% growth year, you could get 60 points. And then you can get it the next year and the next year. So a pretty exciting piece of paper. But in the war, all the sovereign credit and the warrants trade on top of each other. And I did own a little bit of both, but I was weighted towards the warrants. And this is the lesson I learned from Andrew. When you have a distressed puke, there might be unique provisions, but people don't focus on these upside optionality. And you probably paid an extra 2 or 3 points for the warrants, which ended up being worth an extra 30, 40 points when things eventually recovered. So I thought that was kind of interesting. And we bought a lot of these. We joined the group. There was a consent decree, which was kind of forced on the warrant holders' heads. There's a fund, Aurelius, which you might have heard of, which is the biggest warrant holder, and they're known as the most aggressive litigious fund. But in this case, even they backed down, and everybody signed this consent in the summer because you wanted to support the people of Ukraine. And for the consent, you're getting a 12-point fee to be paid 2 years subsequent, so summer of 2024. And we eventually got that fee, so we sold our bonds at 75 plus 3 points of coupon and that 12-point fee that we got today they're trading at 86, and there was actually a blowout document last week about further negotiations. So that's the last of the Ukrainian war opportunity, and now I'm going to touch a little bit on Puerto Rico, the gift that keeps on giving. One of the largest bankruptcies, but guess who makes a reappearance in our presentation? The very same Natalie Teresco was appointed by Barack Obama and the PROMESA board, which was the Obama-appointed U.S. oversight board of the Puerto Rican restructuring. And Puerto Rico was a $74 billion bankruptcy with all kinds of boxes and bells and whistles, and it created a lot of opportunity. And it's going to be hard for me to go through all of them. I'll bore you to death. But I'll give some highlights. There was a double dip bond, which is the Public Building Authority, because basically what Puerto Rico did, it was very corrupt. So they had GO bonds, general obligation, but then they wanted to raise as much debt as they possibly could. So they would create all these entities, revenue bonds based on the HTA, the Highway Authority, or the PREPA, Puerto Rico Electric Power Authority, which I own a few million bonds to this day in PREPA. But they would create all these different boxes that they would use to issue incremental debt. And the PBA, Public Building Authority, had a double dip. So they had a GO obligation claim and then a second claim on all these buildings and assets. So but they were trading cheaper than the GOs. So that was a unique opportunity. That was a trade I did with Andrew. So yeah, that was a good one. I'll move on. So now it's the play-at-home opportunity. So one of my friends in the audience knows this well. And it's a CVR. So another one of these complicated acronyms that everyone can understand, but they make complicated in finance. So CVR stands for a contingent value right. And for whatever reason, there's been a crazy trend. In the last couple of months, we've seen like 10 or 12 CVRs, which creates a lot of opportunity for us. So a CVR is a way for an investment banker to bridge a gap between buyer and seller in a large merger, and it will typically be based on something that has an uncertain outcome. So it's more common, much more common in biotech and healthcare, but maybe, nobody knows how this drug's gonna do, nobody wants to take that risk, so they say, hey, why don't we create a CVR, you'll pay X dollars in cash, and we'll create this stub, and the owners of the legacy stock will be entitled to receive that CVR or that upside contingent future payout at some point in the future. And that's what a CVR is, and that's one of the opportunities I'm going to show you. And it's a company, my colleague here, Seth Feingold, is in the audience, did all the heavy lifting on this situation. It's a company called Arcane Therapeutics. They're being bought by a well-known company, Novo Nordisk, of recent fame. And you're getting $54 a share. And it's contingent. They have a drug for liver fibrosis that is going to go through a phase 3 process at the FDA, and we'll see how it goes. But what you're going to get, and here's the math, you're going to get $6, we estimate, in 5.5 years. And right now the stock's trading at 54.24. For full disclosure, my average is probably 54. So you'll be paying a little bit more than me, but it still has a very compelling IRR. So we don't know if this is going to work. Maybe it doesn't get approved, but you could probability weight it, and Seth did a lot of very good work figuring out comparable phase 3 FDAs with this specific type of drug, and our estimate is a 55% probability of success, and if you discount that back with a hefty discount rate, you create an IRR of 17%. And there's two ways to look at this. You could also call it a 30% IRR. So 17% is if you fully burn in the cash out that you pay, but the more academic way to look at it would be you would extrapolate what the merger arbitrage spreads would trade at without the CVR, and then you kind of back into the value of the CVR in its own right. So I show you both methodologies here. All right. Now I'm going to talk about another three-pronged opportunity that's been this year my most successful trade, the Diamond family, and something that's been very interesting. And so Chicago Bridge and Iron and McDermott. McDermott is an EP&C company, another acronym. EP&C stands for Engineering, Procurement, and Construction. But it's a fancy way of saying a builder, a contractor. But they're like a GC for offshore vessels, energy transition, these massive, long duration projects. And one of the things that threw them into bankruptcy was rebels at one point in Africa kind of bombarded one of their projects. And they've had all these issues for many years, and I've been following this saga forever. And recently we've become a lot more involved and the company's turned a corner, but it's a complicated business. I think the company's actually implemented a new bidding process that makes it a little bit more desirable. But in January 2020, just before COVID, they went bankrupt. Obviously, they're very sensitive to the oil and gas space, so they had a restructuring during COVID, and then they restructured again 2 summers ago. They had like a weird judgment against them, so they restructured in the UK and the Netherlands. But this is kind of the chart of the term loan. We bought this from, we talked about a BWIC. So initially I bought a couple million bonds at 55 like 3 years ago, and then I bought a lot more in the 30s, and it was from a CLO, forced seller. They were going through this restructuring, but they kept the bonds. They did extend the maturity of the term loan. They kept them current throughout, and I thought that was really interesting. I had some relationships close to the company, and everything that I was doing confirmed that this company was about to turn a corner, and they were just afflicted by this weird ruling. And then last summer, we actually got involved in the equity. There was a fund out of Boston. It was the biggest commitment party, the PG&E backstop, very well-known fund, and they was rumored to be selling for months, and they drove the stock all the way down. Arguably, I was buying it at like 1 times earnings or whatever metric you want to use. And that's an inappropriate metric because this is a severely levered company, and 1 times earnings can still be a bagel. But I was buying it was like 150 million market cap, and they had just done a big preferred for equity flush. So they had simplified their capital structure. And most importantly, my friends over at Mason Capital, Mike Martino and Ken Garshina, they had just joined the board. And I know that they are a large stockholder. They were the ones that orchestrated that debt for preferred for equity swap. And they were very conducive to being shareholder friendly here. So I was able to buy the stock, and today it's up 5 times since the summer, which has been a pretty phenomenal return. But they're still trying to restructure or term out some of their debt, and I think they're going to get that done, and that will create even further upside here. And then final leg of that trade, also related to my friends over at Mason Capital, was the lift out. And this was a very uniquely suitable transaction for the Diamond family office, where we purchased an entity within McDermott, which was kind of the best house in a bad neighborhood. We bought Chicago Bridge and Iron, which is the EPNC, again, specifically for oil and gas storage tanks. Their customers are Saudi Aramco, Abu Dhabi Oil and Gas, and we put $15 million. And the concept was, this is a company, or the subsidiary had been plagued by the parents. While they had never had a down year in like 15 years, they were not able to win new business because they didn't have a clean balance sheet. They couldn't post letters of credit. So there were a number of very prominent investors, not myself in this deal, Jeff Gandel, and I was able to join. I actually was working with Mason on this deal for 2 years before it consummated in various different iterations, and I was fortunate enough to participate, and the company's really on track. I'm going to be going to the board meeting next week, and we bought it for 5 times EBITDA. I anticipate a really good outcome, and you'll probably see it as a public company sometime 2 to 3 years from now. All right. So, well, that's it for all the trade ideas. I'm going to talk just a little bit about asset allocation, because that's a big part of my role. In addition to doing these fun things, I also oversee the asset allocation. I think about rebalancing, how much we're in equities, how much we're in cash, private equity, alternatives, etc. And I think for everybody in their personal balance sheets these days, it's a really important consideration. So you see this beautiful ChatGPT generated graphic, and I asked it to make this because I remember a very similar graphic with Ben Bernanke during the financial crisis. But just in the last 2 weeks, President Trump and Scott Bessent said they're going to ship out money. Yesterday, Bessent said every new baby is going to get $1,000 in the stock market. And President Trump last week said everyone's getting a $2,000 tariff check. So we can all get in line. But I think that's very destructive for our currency, and it makes it very hard. I think asset allocation right now is the hardest it's ever been of my life, because, here are the key things. Cash is trash, and you can't sit in cash, or you can, but it's hard. And stocks are at all-time high. Equity, that's nominally, but from a multiple like a forward PE, we're pretty close to it, right? So what do you do? And I call that the allocator's conundrum. And my solution is, you got to own some gold. That's been my biggest new allocation 4 years ago when I joined the Diamond family office. First thing I had them do, and fortunately they mostly listened, was to put 4 or 5% of our money in gold. And you got to invest in alts, hedge funds, credit. There's some really wonderful hedge fund managers that can take less risk and kind of create a return that's more stream-like in the high single, low double digits. And then even within equities, I think you kind of have to own some equities. Maybe you rebalance down as they continually go up. But, I think you got to think, like, you got to avoid the Mag 7. When we deploy into equities, we'll use a cap-weighted S&P. We'll look at multi-cap, we'll look at mid-cap, not really small cap. And increasingly, we've been investing more in international stocks and MSCI World or the equivalent, just to get a lower multiple, better opportunity. I mean, are we in an AI bubble? Are we not? My opinion is we are. I've been wrong on that for too long. So I'm not going to opine on that, but I did. But it's hard. So maybe today was a crack, and we'll see. But the market is really crazy, and you got to pick the most value realistic nooks within the market. I'm going to talk a little bit about gold because I am a gold bull. I get asked a lot, should we sell our gold? Gold's gone up a lot this year, right? Best performing asset class for 2 years in a row. And my answer is, gold is like your cash. It's not so much that gold or even stocks have gone up. It's that unfortunately our dollar has gone down. And that's what we need to be cognizant of. So, like selling your gold is, I got asked that, I said, well, I'd tell you to put it back in gold. And, do you need to own 20% in gold? No, but you own 5%? In my opinion, hell yeah. But gold is very volatile. It's not like gold is really, unvolatile or this anti, So you see right here, the 7 largest drawdowns the last 50 years, the average is the same between the S&P 500 and gold. And here is the annualized volatility. They're remarkably on top of each other for both the last 10 and the last 15 years. Gold and equities, they may be volatile at different times or in different ways, but they are volatile. So why do we own gold if it's just as volatile as stocks? And my response is pretty simple. It's a diversifier of first resort with long history. It provides anti-dollar protection. It's a store of value, and it could decouple from equities. At times it does, at times it doesn't. Times when equities sell off, you see gold sell off less, but in the same magnitude, but then it comes back first. Sometimes gold goes up and stocks go down, and it's not a great scenario, but I think it's possible. So last slide, finally, why do we own gold? It's the Bitcoin of the Bible. Everybody loves Bitcoin. I don't have a problem with it. A lot of people own it for the same reasons why you own gold. But if you look at history, gold's been around forever, and I think it's an important piece of everybody's portfolio. And that's it. I'll turn it over to Contingent. Thanks for listening. Or we might do some Q&A.
Just help MC with the hand raises here. There are 2 mics in the back.
You need the mic?
Yeah. It's easier for people to get behind you.
Thank you.
What's your preferred vehicle for gold? The actual metal or miners or something else?
That's a tough question. I don't own miners, and I own a little bit of GDX, small, and I regret not owning more because the miners have really started to work, particularly in the last 6 months. Prior to that, they didn't. I find miners to be very hard unless you have the time to really do deep analysis. So if you have a good miner fund, send it my way. I prefer to own gold, and my recommendation is own some physical, and I think the cheapest custodian was the Royal Canadian Mint. And we talked about doing that and owning it there, but ultimately we just own IAU. The 2 largest ETFs are GLD and IAU, and IAU is like 15 bips, GLD is like 40 bips, so we own IAU. And everyone should know from a tax perspective, gold, I think always gives you a blended 28% rather than a long-term, short-term thing. It's taxed as a collectible.
Hi. From your experience, what's the most common mistakes allocators make when deploying capital from a high valuation environment?
Well, I can tell you the biggest mistake I've made as an allocator. And, it's 2 things. Like when I joined the Diamond family, I was very excited to be a seed capital provider. I was like, wow, we can write big checks, we're going to extract economics, and, we'll be partners and we'll own a piece of a fund, a smaller fund. And I think that was a mistake on my part. I think also trying to fit asset allocation into the box is not always the best idea. We talk about it, but there's the bottom up, top down. And I find, at least personally, when I'm evaluating even, funds or funds to invest in, I do a much better job when I'm looking at it from the bottom up. This guy's a great manager I want to invest in, rather than saying, oh, I need a mortgage manager, I need a long-short equity manager. I think that has led me to make mistakes.
right behind you.
Just curious, your opinion in the last 20 years distressed, do you see that the opportunities are fewer, the competition is higher? I mean, it seems like at the Lehman days, there was a lot of opportunities. Now it seems like people are pouncing on deals. Can you talk about that? And do you look at smaller deals, or what's the edge now?
I think you really hit the head on the nail there. The default rate has been subdued forever. You talk to bankruptcy lawyers, they're always waiting for the next big opportunity. The bankruptcy lawyers have continued to stay busy through these LME, liability management exercises, but I'm typically not a player in that given my size. So it is harder, but like every once in a while you see one of these big thematics. So like, I kind of like a barbell again. Like I like the crypto bankruptcies were also unique in that many of the hedge funds wouldn't touch it. It was a claims trade, it was complicated, it was crypto, people were, but that was a massive theme. Like just FTX was 12 or so billion, and if you add in Celsius and Voyager, and there were a few other ones, there was a lot of paper there, a lot of opportunity. But it's much harder in distress, and I hope that we will see a point when, unfortunately for the economy, but for me as an investor, there'll be much higher rated defaults and more opportunity. I will be in like some smaller ones like McDermott, right? It was, it's $1 billion capital structure, but I happen to know it well. I do find that personally, when I have experience or I know something from the past, it creates the best opportunity. Another situation, there's a merger that I had a small position in, and yesterday they beat the government in a lawsuit, and then to me it became an even better opportunity. It's a short duration stub and people don't want to buy it. I think the deal's going to close in a week, but I had familiarity there. So probably the best advantage I have, big or small, is a situation that I had known from the past, and then I feel more comfortable.
Irv, I have a question for you. What type of investments are you making now? Is it like within the mix, right, the portfolio mix, the allocations that you're making? Do you see a lot more venture? Do you see a lot more tech? What excites you when you have to write those checks?
I mean, I see a ton of tech and venture, but we're thinking a lot more about moving into international funds, emerging markets funds. We just came to agreement to invest in an emerging markets fund a couple months ago.
When you say emerging markets, is there any specific markets that you're focusing on?
I'd say ex-China, everything ex-China. Maybe not necessarily, I think, what they call frontier markets we probably stay away from, but.
We can take maybe one more and then we'll close it out. Okay.
If you're averse to frontier markets, then what are you doing in Ukraine and Belarus?
I mean, that was a special distressed opportunity. Ukraine, look, my thesis was wrong initially. I mean, I should have said that. My thesis was that the war was going to end in a few weeks. And that didn't happen. But the economy of Ukraine has been remarkably robust, maybe because of U.S. support. Belarus was just a complete yo, and it worked.
Well, thank you, everyone. Thank you, Irv. This was amazing.
Thank you all so much. This was fun.